Investing in physical gold is pretty convenient. It takes up very little space, never spoils, and stacks quietly in a vault for decades. Crude oil is a different story. If an everyday investor or a Wall Street firm wanted to invest $1 million directly into physical oil, they would suddenly have to literally take delivery of thousands of barrels of highly flammable, incredibly messy sludge. To solve this logistical nightmare, the financial industry created exchange-traded funds, or ETFs. These tools allow anyone to get exposure to the price of a commodity without ever needing to rent a tanker truck or build a pipeline. But because these funds can't hold the physical stuff, they have to hold abstract digital contracts instead. And operating entirely in the abstract introduces a set of hidden mechanical rules. Instead of buying physical barrels, an oil fund buys delivery tickets promising a set amount of oil in exactly 1 month. There's a ticking clock attached. As the month closes, these tickets expire. If held at zero, real trucks deliver real oil. Since the fund has nowhere to put that oil, they have to execute an escape maneuver. They play a massive financial game of hot potato, selling their expiring ticket to someone who actually owns a refinery right before the deadline. But the fund still needs to stay invested in oil for its clients. So the very second they sell the expiring ticket, they take that cash and buy a brand new delivery ticket for the following month. Commodity investing is a relentless, repeating loop of throwing away an expiring ticket and buying a fresh one 12 times a year. What actually happens to your money in the few seconds it takes to swap the old ticket for the new one? Under normal conditions, the market enforces a strict rule. The brand new ticket for next month's oil almost always costs slightly more than the ticket you are trying to get rid of today. This price difference exists because physical reality demands it. Storing millions of gallons of hazardous liquid requires sprawling facilities, round-the-clock security, and expensive insurance policies. The market charges you a premium for next month's oil to cover the cost of keeping it safe for another 30 days. Let's look at the math behind the swap. If your fund sells its expiring ticket for $75, but the market demands $76 for the new one, you lock in an automatic $1 loss just to stay in the game. $1 might sound small, but this mandatory tax triggers month after month. Over a full year of swaps, those tiny individual cuts stack together and severely drain your account balance. Financial professionals call this upward-sloping market penalty contango. Contango functions exactly like a hidden subscription fee. It steadily bleeds your investment dry to pay for the industrial warehouses holding the oil you refuse to touch. There is a rare exception to this rule. When a severe winter freeze or a sudden geopolitical shock hits, the supply chain breaks down. The psychology of the buyer completely flips. Factories and power plants desperately need the fuel today to keep the lights on and stop pipes from freezing. They do not have the luxury of worrying about what happens next month. This panic inverts the math. The expiring ticket, the one that guarantees immediate physical delivery, suddenly becomes the most highly prized asset on the board. The fund can now sell its highly desired immediate ticket to a desperate buyer for $76, turn around and buy the cheaper far-off ticket for $75. Every time they swap, they capture a $1 profit. When the market flips upside down like this, it enters a state called backwardation. In extreme emergencies, the market essentially pays you a premium for being willing to wait, turning a normal penalty into a mechanical monthly windfall. An investor's final return is the result of two separate forces colliding. Total return combines the physical price movement with the gain or loss from monthly ticket swaps. This is how an oil fund finishes the year down 10%, even when physical prices stay flat. The cost of swaps drags the investment underwater. Conversely, during global supply shocks, funds capture returns that are partially independent of whether the price of a barrel keeps rising. The market panic creates a profitable swap that supercharges the investment. When you look at a commodity price scrolling across a news screen, you can see the invisible mechanics working behind the number. Successful investors don't just track the price of the goods, they calculate the gap between these delivery tickets to find the true cost of the bet.